Hi class, in this video we're going to work through the Chapter 8 brief exercises. So we will start with brief exercise 8.1. So we're looking at Smalley Incorporated. It purchased items of inventory as follows. On January 4th, 100 units at $2.10 each. On January 23rd, it bought another 120 units at $2.25 each. Smalley sold 50 units on January 28th. Compute the cost of goods sold for the month under the FIFO inventory method. Okay, so we're finding cost of goods sold under the FIFO inventory method. So with FIFO, it's an inventory cost flow assumption for book purposes. So this doesn't mean that that's actually how inventory is flowing. But with FIFO, we're assuming first in, first out, right? So the first items that we purchased, the older items, are the first ones we're assuming are sold. So when we look at these two cost layers, January 4th is the older cost layer, right? And then January 23rd is the newer one. So if we're using FIFO, how are we going to find the cost of goods sold? So it said they sold 50 units. Okay, so for this one, I'll go ahead and let's copy these cost layers just to illustrate. Then we have January 23rd. Okay. So under FIFO, we're assuming we're pulling from the oldest cost layer first. We're working our way from the top down. So if we sold 50 units, there's enough units in this first cost layer to cover all 50 units, right? So we're going to assume that those 50 units we sold are coming from this batch of January 4th, this cost layer. So each of those we're assuming are the ones that cost $210 each to acquire. So we'll do $210 times 50, that's $105 for cost of goods sold. What does that leave us with? That leaves us with 50 units in that cost layer on the books, and that second cost layer is untouched. All right. Let's move on to 8.2. Mason Company purchased items of inventory as follows. On December 2nd, it purchased 50 units at $20 each. And then December 12th, it purchased 12 units at $21 each. Mason sold 15 units on December 20th. Determine the cost of goods sold for the month under the LIFO method. So LIFO is the opposite of FIFO. This is last in, first out. So this means just for bookkeeping purposes, when we sell items, we're assuming we're selling the newer stuff first, the stuff we bought most recently. So we're going to pull from this cost layer first and then work our way up. So we sold 15 units. So we're assuming those 15 units are first coming from this cost layer down below. Well, there's only 12 in that one, right? So we're going to assume that 12 of the units that we sold have a cost of $21 each. But then that cost layer is gone now. But if we sold 15 units, that means we need to pull 3 from this one. And if we're pulling from that cost layer, each of those cost us $20 each to acquire. That means we have 47 units left of that older cost layer. Okay, so let's do 12 times 21, 252, and that should be 60. Let's add those two together. That gives us $312. So that's our cost of goods sold using the LIFO method. Now, does this mean that if I go into the physical storeroom that there is 47 units left of the December 2nd batch and nothing of the December 12th? Not necessarily, not at all, right? Because when we're talking about one of these methods at a time, we're talking about one kind of inventory. All these units that we're buying and selling are homogeneous. They're all identical to one another. So what actually gets pulled off of the shelf When it's sold doesn't matter. That's besides the point. But for bookkeeping purposes, we just need to figure out some standardized method, whichever one is picked, to determine, okay, when we make a sale, what are we assuming? Or which batch are we assuming we're pulling from first? Okay? So our cost of goods sold for this one is $312. We'll move on to 8.3. Fox Company purchased items of inventory as follows. So we have May 3rd, purchased 100 units at $3.05. May 10th, purchased 150 units at $3.10. And then May 15th, purchased 120 units at $3.15. Okay. By the end of the month of May, Fox had sold 125 units. If the company uses the average cost method of accounting for inventory, what is the amount of the ending inventory? Okay, so with the average cost method, you first want to figure out what the total cost is of your inventory. So the May 3rd, that's 305. May 10th, do 150 times 310, that's 465. And then 120 times 315, so that's 378. We'll add all of that together. That's $1,148 of total cost. And how many units does that total up to? That's 370 units. Okay, so to find the average cost, you're going to take that 1,148 and divide it by the total amount of units it refers to. So what is the average cost for each unit? That comes out to about $3.10. We'll average that to the nearest cent there. About $3.10. Okay, so they're asking us not what the cost of goods sold is, but actually what the cost of the ending inventory is. So we had 370 units, and they said they had sold 125 of them. So if they sold 125 units of the 370, how many units are we left with? That leaves us with 245 units in ending inventory. So all we're trying to figure out is what's the cost of these 245 units using average cost. We'll multiply it by the average cost of 310 per unit. So the average cost of this ending inventory, we'll round that to about $760. So average cost of the ending inventory. Okay, now what if they asked us for the cost of goods sold instead? Well, they told us they sold 125 units, and if the average cost of each unit is $310, we'd have simply done 125 times the $310 to give us $388 for our cost of goods sold there. Okay? So whatever they end up asking you, and you just want to be careful, are they asking for ending inventory cost or cost of goods sold cost? Okay? All right, so that was 8.3. Let's move on to 8.4. Okay, Murphy Incorporated purchased a new inventory item 2 times during the month of April as follows. April 5th, they purchased 100 units at $5 each. And then April 15th, they purchased 100 units at $5.05 each. Okay, so they want us to figure out for A, what is the amount of ending inventory of this item on April 30th if the company has sold 75 units and uses the LIFO inventory method. So using LIFO, we want to find out what our ending inventory cost is. Remember with LIFO, when we sell items, we're pulling from the bottom first and working our way up, right? So if we're using LIFO and we're selling things, then if we're selling the newer stuff first, that must mean we're left with the stuff that's left over is the older stuff, right? Ending inventory must be the older items. So to find out ending inventory, we'd work from the top to the way down to make up that ending inventory amount. So it says, what if they sold 75 units? So we can see how many units do they have available here. 200 units available minus the 75 units that they sold would mean that there are 125 units in ending inventory. So we want to know what the cost is of that ending inventory. So we'd start at the top and work our way down. Since with LIFO, if you're selling the newer stuff first, that stuff that's left over, the ending inventory is made up of the older items. Okay? So if there's 125 units left, that must mean that this whole inventory layer, the older inventory layer is still there, right? So that means there's 100 units at $5 each left, which would be $500. But then that means there's still 25 units of the newer cost layer left since we sold 75 of the newest batch. Or that's the assumption, right? Just for bookkeeping purposes. So we'll do $5.05 times 25. That gives us $126.25. So what's the total cost of my ending inventory using LIFO? That's $626.25 ending inventory cost. Okay? So again, we're looking at what was left over. Now, what's another way we could have done this? Well, you could have found your cost of goods sold first and then subtracted it from your cost of goods available for sale. So if we have that table, you could have multiplied across and see what each cost layer represents. So that'd be $500 and $505 for a total of $1,005. Okay. Now the cost of goods sold, we sold how many units? 75 units. So under LIFO, when you sell items, you pull from the newest layer first, right? So that means all 75 units we're assuming are coming from the April 15th batch at $5.05 each. So if we do 505 times 75, that's $378.75 for the cost of goods sold. Okay? So if you're more comfortable finding cost of goods sold all the time, you can do that first, and then take your cost of goods available for sale, which is the total cost of the inventory up at the top, your cost of goods available for sale, minus your cost of goods sold that you just found, should give you the cost of your ending inventory. So let's see if that works. So we have 1,005 minus 378.75. Oh, let me do that again. 1,005 minus 378.75. That gives us $626.25, just like we found before. Okay? So using the LIFO method, we just found the cost of the units left over. Okay? So you can do it the first method that we did, or you can always find cost of goods sold first, and then subtract it from your cost of goods available for sale to find that ending inventory. So that was just for A. Now, with B, they're asking how would this differ if the company used FIFO instead? Okay, so let's do this. Oops. What I'm going to do is I'm going to take this table and I'm going to copy it down here. Okay, so now we're going to do the same thing, but assuming the use of FIFO. So first in, first out. They're asking us what is the cost of the ending inventory. Remember, 75 units were sold. So with FIFO, we assume the older stuff is sold first, right? We work from the top all the way down. Okay, so that means, okay, if I'm assuming for bookkeeping purposes that I'm selling the older stuff first, that must mean that the stuff that's left over is the newer stuff, right? Mostly made up of the newer items. All right, so if we had 200 units available minus the 75 units we sold, that means we have 125 units left, right? So how are we going to figure out the cost of those units left? Well, they must be made up of the newer stuff first. So that must mean that we're assuming we have all 100 units of the April 15th batch still left. And then 25 units of the older batch still left, right? Be 125. We do 505 plus 125, that gives us $630. So that's our ending inventory cost using FIFO. Okay, but how else could I have figured that out if I like finding cost of goods sold usually first? All right, well, we sold 75 units. Under FIFO, we assume we sell the oldest stuff first, right? So we're going to assume those 75 units all came from the April 5th batch. So the 75 units we're assuming have a cost each of $5. So 75 times 5, that gives us $375 for our cost of goods sold. But remember, once you have your cost of goods sold, you can find the cost of your ending inventory. You simply take the cost of goods available for sale, which is the 1,005, minus the cost of goods sold, which we just found to be $375 now. That should give you the cost of your ending inventory, right? So we'll do 1,005 minus 375. That gives us $630, just like we found before, right? So both of those match up. So whichever way you are more comfortable with. Okay, so that was 8.4. So we'll move on to 8.5. All right, with 8.5, FIFO and average cost. So it says Franklin Company had 10 units of an inventory item on hand at the beginning of the year, each of which had a per unit cost of $10. So we have beginning inventory, 10 units at $10. During the year, 20 additional units were purchased at $11. Okay, so we have purchase. They purchased 20 units at $11, and 25 units were sold. Okay, we'll keep that off of there. What is the amount of the ending inventory under the LIFO and the average cost methods of accounting for inventory? Okay, so let's find each cost layer's total. So it'll be 220. So the cost of goods available for sale here is $320, or the units available would be 30 units. Okay, so it says we sold 25 units, right? So if we sold 25 units, how many units would we have left of the 30? Only 5 units left. So 5 units would be in our ending inventory. So under LIFO, remember last in, first out when we sell. So those 25 units, where do they come from first? They would come from the purchases batch first, and then we'd work our way up, right? So under LIFO, what's left is made up of the oldest stuff first. So what's our oldest batch? The beginning inventory, right? So those 5 units that are left must come from that beginning inventory cost layer. So our ending inventory cost must be $50. Now, remember, we could have done cost of goods sold first, right? If we sold 25 units, with LIFO, you assume you sell the last that came in, right? The newest stuff. So if we sold 25 units, we're assuming we're pulling from that purchases cost layer first. So 20 units at 11, but then we would have to dip into the older cost layer, right? Which would be 5 units at 10. Be 50. So in that case, our cost of goods sold would be $270, right? Well, remember, you take the cost of goods available for sale minus the cost of goods sold, which we now found to be $270. that should be equal to the cost of your ending inventory. So if we do 320 minus 270, that gives us a $50 for cost of our ending inventory. Okay? So that is the LIFO method being used here. Okay, so let's take this table and we will copy it down here for the average cost method. Okay, so now the question is, well, what about the average cost? What would that look like? Well, with the average cost, remember you take that total cost of your inventory, the total cost of goods available, and divide it by the units to see what the total average cost comes out to. So that'd be 320 divided by 30. That's an average cost per unit of about $10.67. Okay, so that's our average. Oops. Let's move that back out. Okay, so $10.67. So now with average cost, again, we're trying to figure out what the cost is of our ending inventory. Remember we said we have 5 units left because we sold 25 of the 30. We'll just take those 5 units, times it by the average cost per unit. That gives us, in this case, $53.35 for the cost of our ending inventory. Okay? Another way, once again, you could have found your cost of goods sold using this method. Take the 25 units, times it by the average cost per unit. Take 25 times 10.67. That's $266.75. And that would be cost of goods sold. Let me scroll up here. We might have a slight rounding error. Then we have our cost of goods available for sale of $320 minus our cost of goods sold can give us our cost of our ending inventory. So if we take the 320 minus the 266.75, that gives us 53.25. So we're just slightly off due to the fact that we rounded. But in this case, you don't even have to do it the second way, right? Because of the average cost, this is the easiest one out of all of them. Once you find that average cost per unit and you know you have 5 units left, you can just do a quick multiplication problem to find the cost of that ending inventory. Okay? Very good. That was 8.5, so we will move on to 8.6. Brewing company's inventory is subject to shrinkage via evaporation. At the end of the current financial reporting period, the company's inventory had a cost of $100,000. Okay? Management estimates that evaporation has resulted in a 6% inventory loss. Assuming that loss is recorded in a separate inventory loss account, prepare the general journal entry to record the inventory shrinkage of the year. So if 6% of this $100,000 of inventory is estimated to have evaporated, let's first figure out the dollar amount of evaporation. So 6% of $100,000, that's $6,000 of shrinkage. And shrinkage refers to inventory loss due to breakage, theft, spoilage, and stuff like that. Okay? Now this is normal. In this case, whatever this company is working with, they just expect this to happen. Okay? So they have to record this loss of inventory. So they tell us that they use a separate inventory loss account. So if we actually lost inventory, it evaporated, there's some of it missing, right? We have to record the fact that inventory has declined. So we will credit inventory. But what would be that offsetting debit? The offsetting debit will be something called shrinkage loss. It's a loss account, which is like an expense account in terms of how it reacts and what we do to that account. A loss has the same effect on net income that an expense would. So just like expenses and dividends, you always debit any kinds of losses when they go up. So we're going to debit shrinkage loss for $6,000, and we will credit inventory for $6,000. Okay, so this entry records the decrease in inventory, but specifically indicates that it's due to shrinkage, and this shrinkage loss will be shown on its own on the income statement as a separate line item. Okay, now if this isn't considered material, or if the company doesn't care to keep a separate shrinkage loss account, what they will do, in many cases, you will see that they will just throw it into cost of goods sold. So they will treat it as if they sold it. Okay, at least just this cost side of it. Since you actually didn't get any money for this evaporated product, there is no sale entry. But this would be the alternate entry, where you treat it just as part of cost of goods sold. You treat it as if you sold it, and you dump that cost into cost of goods sold. Now, this is common if the amount of the shrinkage is immaterial. But many might argue that any kind of shrinkage is material and would always keep a separate loss account to always keep track of any shrinkage that's happening. Because even if it's small, if you're mixing it in with cost of goods sold, there's no way to tell how much of that cost of goods sold is due to shrinkage and how much of it is actually due to, actual loss of inventory. Okay, so those are the two methods. Just make sure that you read the problem carefully, because it will usually tell you that if the shrinkage amount is below this amount, they will put it into cost of goods sold. If it's larger, they will put it in its own loss account. Okay? Very good. We'll move on to 8.7. Pixie Incorporated overlooked $125,000 of inventory at the end of the current year because it was stored temporarily in a warehouse owned by another company. Before discovering this error, the company's income statement showed the following: sales of $990,000, cost of goods sold of $560,000, and gross profit of $430,000. Restate these figures to reflect the inclusion of the overlooked inventory. Okay, so let's copy this over. 990, cost of goods sold of 560, and then gross profit of 430. So what happened here is the fact that they overlooked some inventory. So when they went to count their ending inventory, there's some of it they didn't count. They overlooked it. So what's happening to ending inventory? Is it under or overstated? Ending inventory is actually going to be understated, right? We actually didn't count 125,000 of it. So visually, I'm going to show you how I like to figure out what's going to be happening here. Now, whether or not this method works for you, that depends on how you learn best, but my method might not be the most creative, but I'll try my best to show you what I'm talking about. So when we're looking at this calculation of beginning inventory plus purchases minus ending inventory equals cost of goods sold, all of these are connected, right? They flow into one another. So, but we have an issue here with ending inventory. There's 125,000 of it that was missing from the books that we forgot to count it, right? To include it with our count. So when you look at ending inventory here, let's get a highlighter. Ending inventory, we said, is understated. So to show that it's understated, just for me visually, I'm going to draw a really cramped box around this ending inventory to show that it's understated. It was smaller than it actually is. On the books, it was too small. So what happens when you subtract a number that is too small? What's going to happen to the number that you're left with if you don't subtract enough? What's going to happen to cost of goods sold here? What's the end result? If we don't subtract enough to get to cost of goods sold will be under or overstated itself. Cost of goods sold will be overstated. I'm going to draw a bigger box around that one. Because we're not subtracting enough as ending inventory, we're going to be left with too much as cost of goods sold. Okay, so this one's under, which causes the cost of goods sold to be over. All right, so how do we fix this? How are we going to correct that? Well, if ending inventory is understated, to get it to where it needs to be, we need to put the 125, we would add it back, right? But if cost of goods sold is too big, in the amount of the 125, to fix it, what will we do to cost of goods sold? If it's overstated, we will get it back to where it needs to be by subtracting that 125. Okay, so cost of goods sold was recorded at 560, but that was an overstated amount, too large. So it's overstated in the amount that we overlooked that inventory. So we'll take that 560 minus the 125. So our cost of goods sold actually is 435. That's our actual cost of goods sold, right? So we wouldn't need to restate sales, right? This has nothing to do with sales, the fact that we didn't count some inventory, we missed out on it. Cost of goods sold, we know, is fixed now. That's actually 435. And guess what? Sales minus cost of goods sold gives us gross profit. So because we fixed cost of goods sold, gross profit also needs to be fixed. Gross profit was 430, right? But now because cost of goods sold is smaller, our gross profit is going to be higher. So let's take 990 minus our new cost of goods sold. That gives us $555,000 for a gross profit. How else could we have gotten the gross profit? Well, again, it was 430, but since we're subtracting a smaller number as cost of goods sold now, that's the correct number. It leaves us with more gross profit. So we would add that 125 into 430. Let's see if we get the same answer. That's 555. So when you are looking at errors in inventory, whether it's under or over, just write down this calculation here, and if ending inventory is understated, put a cramped box around it, which would cause cost of goods sold to be overstated. Or if ending inventory is overstated, put a big box around it, which would make cost of goods sold understated. Okay, so it flows through. And just a side note, if an error isn't caught in that year, if ending inventory is understated and we don't fix it, what does that mean for the beginning inventory of that next year? Remember, they're one and the same. If ending inventory is understated at the end of this year, then going into the new year, beginning inventory will also be understated because the ending inventory in one year is the beginning inventory in the next. Okay, so that error will flow through if it's not caught. Okay, so that was 8.7. Let's move on to 8.8. Due to ineffective controls while counting its inventory, Walker & Comer Incorporated double counted $50,000 of inventory at the end of the year. Double counted. So what does that mean for my ending inventory? If we double counted $50,000 worth of inventory, that means we're $50,000 overstated this time. Before discovering this error, the company's ending inventory was $670,000. How will correction of this error affect the company's inventory and cost of goods sold figures? Okay, well, if ending inventory is recorded at $670 before we found the error, if we know it's $50,000 overstated, how do we fix it? Just subtract the overstatement, the double counting. So ending inventory should actually be recorded at $620,000, right? And then cost of goods sold, they don't give us the number we had before, but what would happen to cost of goods sold? Well, after we correct it, right? So we have beginning inventory plus purchases minus ending inventory equals cost of goods sold, right? So ending inventory, we said, is overstated before the correction of the error. It was overstated, right? And if I subtract too much, what happens to cost of goods sold? Cost of goods sold would be understated. So what do we do to fix an overstatement? We subtract the $50,000, right? But what do we do to fix an understatement? We add the mistake, the amount of the understatement in this case. So to fix cost of goods sold, whatever the amount of cost of goods sold currently is in the ledger, we would just have to add $50,000 to it to fix the fact that we double counted our inventory. Okay? And almost done. So 8.9. Alamo Company has sales, cost of goods sold, and average ending inventory for the current year in the following amounts: $650,000, $500,000, and $128,000, respectively. Calculate the amount of the company's inventory turnover for the year. What is the company's average number of days to sell inventory? Okay, so we have sales of $650,000. We have cost of goods sold of $500,000. And then we have average ending inventory of $128,000. So they're asking us what the inventory turnover is for this company in this year. So inventory turnover is going to be defined as your cost of goods sold divided by your average ending inventory. Okay? So we're looking at how quickly inventory is being turned over, or in other words, how quickly inventory is being sold. So our cost of goods sold is $500,000, and our average ending inventory is $128,000. So let's do 500 divided by 128. So we'll round that to 3.91. This is 3.91 times. So basically, what this tells us is that within this year at least, they had to turn inventory over on average about 3.9 times. That's how many times they essentially had to completely replenish their inventory, right? So that's how gives us perspective into how quickly they were selling their inventory. But we want to convert this into days. So how quickly are they selling their inventory based on this information? So if they're turning inventory over about 3.91 times in a year, you simply take the days in a year of 365 and divide it by 3.91. Convert it to days. So we'll do 365 divided by 3.91. So that will round that to about 93 days. So it takes this company on average about 93 days to sell its inventory. So for any given item of inventory, it's sitting there for about 3 months before it's sold. Whether that's a good or a bad thing depends on the kind of company, right? And the industry that it's in and its past performance. Now, just a side note that I tell all of my students that because a lot of you will end up taking a finance class later on at university, when you get to a finance class, what's common is they will, when they're trying to use the number of days in a year for any calculations in finance, they often use 360 instead because it minimizes rounding error and mistakes and stuff like that. So in finance, the common number of days used for a year is 360, just because it's an easier number to work with. But in our class, we will use 365. Just don't be alarmed when you get to a finance class, and don't be too confused when you see them using 360 for a year instead. Okay? One more. Oh, and also when it comes to these kinds of formulas, financial formulas, you will see different versions of them in different business classes and especially in finance. They all have the same idea, but for this class, or any class for that matter, if you're being asked to calculate a specific ratio or something like that, use the formula that is being used in the class and in the text. Don't go to Google because Google will oftentimes give you a different version of it. Okay, so just a side note there. So we're looking at Rouse Incorporated. They reported sales, cost of sales, and inventory figures for last year and the current year as follows. What is the amount of inventory turnover for each year? And in which year did Rouse manage its inventory most effectively? All right, so we'll do last year. Remember, inventory turnover, that's going to be your cost of goods sold divided by your average ending inventory. Okay, so last year, what was my cost of goods sold last year? That was $85,000, but we'll keep the zeros off. So we're going to divide that cost of goods sold divided by the average inventory of $27,000. 85 divided by 27. We were turning inventory over about 3.15 times each within the year last year. Okay? Now, how long does that mean our inventory was sitting around before it was sold? Well, we take the number of days in a year and divide it by that turnover rate. So last year it took us how long to sell our inventory? Last year it took us an average of 116 days to sell our inventory. Now let's compare that to this year. What's this year's cost of goods sold? $90,000. And what is this year's average inventory? $35,000. So we'll do 90 divided by 35. So we were turning inventory over about 2.57 times within this year. Then how long did it take us to sell any given item of inventory this year? We'll take the 365 divided by 2.57. So it took us about 142 days to sell our inventory this year. So in which of these 2 years, so last year it took us 116 days to sell any given item of inventory. This year it took us 142 days to sell any given item of inventory. So which year were we more efficient in managing inventory? Last year, right? Why was last year more efficient? Because last year it took us about 30 days less to sell any given item of inventory compared to this year. This year, inventory was sitting around for quite a bit longer to sell compared to last year. Now, whether or not these are good or bad figures, again, depends on how these figures relate to a couple accounting periods in the past. Here we're just comparing one year to the next, but also you want to compare it to the competition, right? That gives us a really good perspective on how well a company is managing its inventory. All right, so that's it for Chapter 8's brief exercises.